Hi everyone, and welcome back to our Market Insights series, where we delve into interesting topics affecting equity markets. Today I have with me Cornelius and Jacques. Thank you guys for being here. So let's kick off. We saw quite a strong result season from the S&P 500 this last quarter. Approximately 75% of the companies have actually beat their earnings estimates. What can we make of these results?
Yes, it was a strong earnings season by the US with roughly 16% earnings growth. This is the highest earnings growth that the index has posted in the last 3 years. There was an interesting divergence if you look at the sectors, with the communication services and information technology sectors beating estimates by the widest margin. Those two sectors are of course dominated by the big tech companies. On the opposite side of the spectrum, we saw the defensive sectors like real estate and utilities struggling, as well as the resources sectors with energy and materials struggling to beat estimates. On average, the companies beat by 6-7%, which is roughly in line with the 5 and 10-year history. And then we saw a big divergence between the companies earning majority revenues from the US versus 50% and more outside the US. And this can mostly be ascribed to a mix effect, where the big tech companies earn more than 50% of their earnings from non-US sources, where the index as a whole gets 41% of their earnings from outside of the US. So the domestically focused companies, which is mostly non-tech, they were struggling. So earnings growth were 14%, and then earnings growth from the companies with the majority earnings outside the US came in at 20%.
Microsoft and Alphabet both saw strong results, although the share price sold off. What can we read into this?
Microsoft and Alphabet both sold off around 7% when they reported their results, and it was driven by the cloud growth slowing. The 1% miss for Microsoft's Azure business, I think, needs to be seen in the context of that business still growing around 30% year over year. And a consistent message across the hyperscalers have been that they are capacity constrained and they actually can't keep up with demand. I think another big driver of volatility in January was the release of DeepSeek, a large language model that came out of China that was delivering results on par with the Western models, but was trained at significantly lower cost and using some of the older GPUs. So the market worried about demand for future GPUs. So all of the hyperscalers actually upgraded their CapEx guidance for 2025 by another 15% to try and address their capacity constraints and meet this big demand for their cloud businesses.
So another interesting theme that we've seen is tariffs. Can you maybe give us some of your insights on that topic?
Yes, if we look at the transcripts of the companies, the amount of mentions of tariffs really ramped up. So it's now basically at the same level as 2018 and 19. Unfortunately, the companies couldn't give us a lot of concrete details, which is understandable. The narrative changes every week at this stage. So it's very difficult for them to estimate what the impact on growth or cost inflation will be for their businesses. I think when we're discussing a complicated topic like tariffs, it's very important to remember that the impact will vary quite a bit depending on the industries and even within industries. So if you look at athleisure, for example, there's companies who have zero sourcing from China and other companies source more than 20%. The GP margin structure is also very important. So there's companies like Lululemon that's really not impacted by tariffs, but other companies like the off-price retailers like Ross Stores or TJX, and then other companies like Under Armour and Foot Locker will be really impacted if Trump announces high tariffs on China. So very difficult at this stage to estimate the impact, and it's important to be very selective with the exposure you take.
We've seen Alibaba up around 60% over the last month. What is your take on this?
So the Chinese tech names did rally very strongly. I think a lot of that was on the back of the release of the DeepSeek model that showed that China isn't actually that far behind the West than most market participants originally thought. I think another big positive was Xi Jinping meeting with the private sector. That shows there is collaboration between the private sector and government, and they want to build wealth before they focus on common prosperity. Alibaba reported results. The share was up another 8% on the day, and I think positively the core e-commerce business is back to growth, and the management team there is focusing on improving the profitability of their core business while divesting some of the non-core assets. The share is now still just trading on a 12 times forward price to earnings multiple, and we actually think there's some upside risk to that multiple because the business is now back to growth. Over time, we know that earnings and free cash flow generation drives total shareholder return, and those are coming through very strongly while the management team is still executing on their share buyback program.
Jacques, Cornelius, thank you so much for your time today. It's been really interesting gaining these insights from you. To the audience, feel free to send through any questions or interesting topics you'd like us to cover moving forward. If you're interested in learning more about the cloud industry, join us on the 6th of March for our second session of the Equity Explorer series, where we'll be delving into this industry and the underlying companies. If you'd also like to catch up on our last session, which was on semiconductors, please feel free to reach out and we'll happily send you the recording.